In this video, we are going to learn how we are going to analyze the long-lived assets. In this video, you will be able to learn how to explain the long-lived asset and what are the categories of long-lived assets, how to distinguish between the capitalized and expense cost of an asset, then what is the impact on the financial statements as well as the ratios, and finally, how to capitalize the interest cost and its impact on the financial statements. Let's see what are long-lived assets. Long-lived assets, also referred as non-current assets or long-term assets. These are assets that are expected to provide economic benefit over a future period of time, typically greater than 1 year. Long-lived assets may be tangible, intangible, or financial assets. Examples of long-lived tangible assets include property, plant and equipment, land and buildings, furniture and fixtures, machinery and equipment, and vehicles. Examples of long-lived tangible assets include patents and trademarks. Examples of long-lived financial assets include investment in equity or debt security issued by other entities, such as debentures. Let's see how initially we are going to measure the assets. In other words, initial asset measurement rules. Firstly, all costs necessary to acquire the asset and make it ready to use are included in the asset account, meaning they should be capitalized. Example, when it comes to land, the price paid for land, cost of clearing land should be capitalized. When it comes to equipment, monthly equipment rental, delivery and installation fee should be capitalized. Other costs should be expensed to the income statement. Joint costs incurred in acquiring more than one asset are apportioned among the acquired assets, which means if we take a bulk of computer or bulk of vehicles, so the acquisition cost can be apportioned among the number of assets. Now, let's distinguish between the capitalizing and expensing. First of all, we have to identify what is an asset. Under IFRS, the following rules govern the categorization of expenditure as an asset. First, the expenditure expected to give the economic benefit in future over several accounting periods, as well as it should be reliably measured. So the cost can be measured in terms of rupees and cents. Now let's see what is capitalization. Capitalization is an accounting method in which a cost is included in the value of an asset and expensed over the useful life of that asset. It can be done either by using depreciation or the amortization. Depreciation is done for the tangible asset and amortization is done for intangible assets. This means that expenditure will appear in the statement of financial position rather than the income statement. Normally, there are two conditions when the assets are capitalized. First, the asset useful life should be more than 1 year, and the second one is the asset value should be more than the capitalization limit set by the company for capitalizing. In expensing, the relevant cost is recognized as an expense on the income statement in the same period due to the matching principle, as when the expenses was incurred and subtracted from the revenue to determine the profit. Expensing assumes any expenditure like an operating expense instead of capital investment. Now let's summarize the capitalization versus expensing. So in the capitalization, cost we are going to record as an asset on the statement of financial position. whereas in the expensing, cost should be recorded as operating expenditure on the income statement. While capitalizing any cost and later it should be depreciated over the period of the life. So the depreciation charges are shown in the income statement. When we are expensing the cost, it should be deducted from the revenue. As a result, it will reduce the profitability. Now let's see how we are going to record the cost incurred after the initial use. According to general accepted accounting principles, we have to capitalize the cost incurred after the asset has been placed in use as long as the expenditure only if the asset useful life increases. It can be either increasing its productive capacity, such as attainable production units increases, or increasing its production efficiency, which means we are going to use fewer raw materials, or the asset other economic benefits. If there is no increase in economic benefits, then the expenditure should be charged to the income statement as an expense. I'm going to use the following examples to elaborate more with regard to the capitalization and expensing. A company pays 500,000 rupees for a laptop computer. The computer has a useful life of 3 years, but it does not meet the company's 1 million capitalization limit. So how we are going to record? Are we going to capitalize it as an asset or are we going to charge it as an expense? What's your opinion? In this one, since the laptop computer does not meet the company's capitalization requirement, what we are going to do is we are going to charge it as an expense. So we are going to put it in the income statement as an operating expense. A company pays rupees 200,000 for a maintenance on a machine. The payment exceeds the company's capitalization requirement, but it does not have a useful life. Since the asset does not have a useful life, we can't treat it as a long-lived asset. Therefore, this expense should be charged in the income statement as an expense. A company pays 300,000 for Wi-Fi router, and the router has a useful life of 4 years and it surpasses the capitalization limit of 1,000 rupees. So how we are going to record? Are we going to capitalize this or are we going to charge it as an expense? In the previous one as well. So here, since the asset has a useful life more than 1 year and it surpasses the capitalization limit, we should capitalize it as an asset and we have to depreciate the value over the period of useful life in the income statement as a depreciation. Now let's see the effect of capitalization on the financial statements. Initially, when an expenditure is capitalized, the statement of financial position, non-current asset value increased by the capitalized amount. Then in the statement of cash flow, the investing cash flow decreases. Why? Because we have spent money to purchase the relevant asset. In the subsequent period, over the asset useful life, we have to depreciate. So, in the income statement, depreciation when it's a tangible asset or if it is an intangible asset, amortization expenses should be calculated. As a result of this depreciation and amortization, the net income is decreases. When it comes to statement of financial position, the non-current asset value is decreased by the relevant depreciation or amortization expense. As a result, the retained earnings also decreases. Altogether, the equity value also decreases because of the depreciation and amortization expenses. Now let's see effect of expensing on financial statements. When an expenditure is expensed in the income statement, net income decreases by the after-tax amount of the expenditure. Since we are not capitalizing, there won't be any depreciation or amortization expense in the income statement. When it comes to statement of financial position, no asset is recorded. At the same time, it will lower the retained earnings due to lower net income. When it comes to statement of cash flow, operating cash flow decreases because of the expensing value. Now let's see the effect of capitalizing versus expensing. Capitalizing means we are going to capitalize or add the value to the asset value. Expensing means we are going to charge it as expense in the income statement. So if we are going to capitalize an expense, the total asset will be higher. If we are going to record it as an expense, then the total asset value would be lower in the expensing. When it comes to equity, if we are going to capitalize or add the value, then the equity value would be higher. If we are going to record as an expense, then the net profit will be lower. As a result, equity also will be lower. The income variability means the change in income. So if we are going to capitalize the cost, then there will be a lower impact on the income variability. However, if you are going to record it as an expense in the income statement, income variability or change in income would be higher. So let's see the effect on the net income. If we are going to capitalize or add the value to the asset, then in the initial period or in the first year, the net income value would be higher. However, if we are going to record it as an expense, since we are going to charge it into the income statement, net income value would be lower in the expensive method. In the latter period, we know that if we capitalize a cost, then we have to depreciate it or we have to amortize it. Then, under this method, the net income value would be lower if we capitalize it. But in the expensive method, we know that we are charging it directly to the income statement in the relevant period. So, in the later period, if we are going to expense it, then the net income would be higher. Why? Because we have charged it already in the initial periods. Let's see the impact on the cash flow. So, the cash flow from operations will be higher if we capitalize it because they have no impact on the profit. However, if we are going to record it as expense, you know that in direct method, cash flow from operations calculated from the operating profit. So, if you are going to record it as an expense, the operating profit may be lower. Therefore, as a result, cash flow from operations will be lower. Let's see the impact on the cash flow from investment. So, if we are going to purchase an asset, the relevant cost will be charged in the cash flow from investment. Therefore, if we are going to capitalize, the cash flow from investment will be lower. However, if we are going to record it as expense, then there won't be any impact on the cash flow from investment. Therefore, the cash flow from investment value would be higher if we are going to expensing an investment cost. Then let's see the gearing. So when we are going to capitalize, we know that the equity value or the denominator value would be higher. Then the capitalizing cost would have a lower impact on the gearing ratio. However, if we are going to record it as expense, our denominator equity value will be reduced. As a result, debt to equity ratio or the gearing will be higher. Let's see the impact on the interest coverage. Interest coverage is the earning before interest and tax value divided by the interest cost. So, if we are going to capitalize a particular expense, then we know that earning before interest and tax will be higher. As a result, the interest coverage ratio will be higher. But if we record it as an expense, the EBIT will be lower. As a result, interest coverage ratio may be lower in the initial periods. However, we know that in the later period, if we are going to capitalize an asset, then what will happen? We have to charge the depreciation or amortization. As a result, earning before interest and tax may be lower. Therefore, the interest coverage is lower in the latter periods under capitalizing. However, if we are going to expensing it in the initial period, there won't be any value for the latter periods. As a result, the EBIT under expensing method would be higher. As a result, interest coverage also will be give a higher result. So let's see the impact on ROA and ROE. Both ROA and ROE, the numerator is the net income. In ROA as well as in ROE, the denominator value would be higher if we are going to capitalize the cost. Therefore, in the capitalizing method, ROA and ROE will give a higher result. So in the expensing method, the net income will be deteriorated by the expensing charge of the asset. As a result, the ROA and ROE will give a lower value. Now in the later period, due to depreciation and amortization, the net income will be lower in the capitalizing method. As a result, the ROA and ROE will give a lower result. However, we have already charged the expense in the initial period. Therefore, there is no impact on the net income in the latter periods. As a result, the ROA and ROE will give a higher rate. Let's see interest capitalization. Interest cost associated with self-constructed or acquiring assets should be capitalized. Capitalized interest reported as an asset cost in the statement of financial position. Thus, it is reported as part of the asset depreciation expense in the income statement. Now, let's see how we are going to record the interest cost on construction and constructed assets. Interest costs during the construction are capitalized as part of the asset if the borrowed funds used specifically to finance the construction of the asset. The interest paid to prepare the asset for its intended use is considered to be a cost. Here, the interest rate can be calculated by using the borrowing rate, or if not, if there is no debt outstanding, use the weighted average interest rate of all outstanding debt not specifically borrowed for the asset under construction should be used. which means if we are taking a loan, if we have a specific borrowing rate, that should be used. If we don't have a specific borrowing rate, then we have to take all the outstanding loans borrowing rates, and then we have to do a weighted average calculation, and then we have to apply that particular rate to capitalize the interest cost. Now let's see how we are going to treat the capitalization and expensing interest cost. When we capitalize the interest cost, it should be reported as part of the asset on the statement of financial position or the balance sheet. And once the construction is completed, it will be written off as part of depreciation over the useful life. The payments for capitalized interest cost are classified as an investing cash outflow and never as cash flow from operations. Now let's see how we are going to treat expensing interest cost. Here, future interest cost on remaining borrowing made for the construction of the asset must be expenses. Payment for such non-capitalized interest costs are reported as cash flow from operations. The total interest cost along with the amount capitalized must be disclosed as part of the notes to the financial statements. Now let's see the effect of capitalization interest on financial statements. By capitalizing, it will provide the higher net income as well as higher interest coverage ratio during the period of capitalization because earning before interest tax will be higher. Higher asset value and the depreciation which lead to lower net income and interest coverage in the later periods. Now let's see the effect of expensing interest on the financial statements. Since we are going to record it as an interest expense, it will lower the non-current assets value and the total asset value. Further, it will lower the income because we are recording it as an interest expense and it is higher. It will lower the cash flow from operations and it will increase the cash flow from investment activities as payment for capitalized interest would be classified as investing cash flow and be reversed to be operating cash flows. Finally, it will lower the interest coverage ratio as the adjustment would produce lower earnings before interest and tax but higher interest expense.